Hello everyone and welcome to my video blog. My name is Nrupin and in this video we will take a look on price to earning ratio, also known as PE. It is considered as one of the most important ratios when it comes to analyzing business. To calculate PE, we just divide current price of stock by earnings per share of business. PE is considered as important because it gives us relationship between price of stock and earning potential of business. In easy words, we can say that PE helps us see price of stock in multiple of business's earnings. To understand what that means, let's take a look on simple example. Suppose Bunty wants to sell his soda business to you. From last few years, Bunty Soda is consistently generating profit after tax of 10,000 or above. Bunty offers you price of 200,000 for his business. Now before you buy Bunty Soda, you have to make decision is the price tag of 200k is fair price for soda business or not. So you assume that soda business will stay in market for next 10 years generating profit after tax of 10,000 or above. During these 10 years, you have two expectations from business. First, you want to make invested money back from business. Next, you want to generate good amount of profit. Therefore, if you are buying business for 200k, you need business to generate that amount in less than 10 years. Expecting Bunty Soda will generate 10k every year. It will take 20 years just to recover the cost of investment. Since business's life expectancy is just 10 years, you will need 20 years just to cover your investment. 20k is extremely bad price to pay for Bunty Soda. In other words, we can say that Bunty Soda's PE is 20 and it is extremely high. Now if Bunty offers you business for 40,000, you will need just 4 years to cover cost of your invested money and rest 6 years of earnings will be your profit. In this case, we can say that you are buying Bunty Soda for PE of 4 and that PE is cheap. The logic behind concept of PE is that it gives you number of years business might need to generate enough profit to cover your invested money. In theory, that may sound like very good metric to measure business, but as always, every concept has its advantages and limitations. And limitation of PE is that in stock market, price of stock hardly represents true valuation of business. So while buying stock, you will either get stock for high PE or low PE. While investing in stocks, this is one big problem that needs to be tackled while using PE as valuation. Therefore, different investors have given different opinion on using PE as evaluation. Benjamin Graham has recommended to buy businesses with low PE. Peter Lynch recommended comparing PE to growth rate of business. Bill Miller suggested to see PE as vote of confidence with respect to future. Whereas investors like Zach DeFries, Will O'Neill, David Rand, and Mark Minervini believe PE is probably the least important factor in stock analysis. For time profits of business keeps getting bigger, PE keeps expanding. Low PE stock deserve low PE. Now your problem is who to trust and why. To understand that, you need to fully understand limitations of PE, and that limitation is stock prices do not represent true valuation of business. Stock prices actually change based on public opinion. Price changes every day, so does its PE. Next, earning might fluctuate over time, which can also lead to change in PE. Since price and earnings are influencing factors, how these two will change over time determines how you should take a look on PE. Benjamin Graham would prefer to invest when stock valuation of business would be equal to its market valuation. Therefore, he suggested buying low PE stocks. Peter Lynch would invest in businesses with popular products. Popular products usually have growing sales, earnings, and cash flow. Therefore, he suggested investing in relationship of PE and growth rate of business. Growth investors prefer businesses with fast track growth record in current market condition. Therefore, P is useless number because it expands for time, fast track growth remains steady. P can be calculated in two ways, and depending on business in question, their use can vary. First calculation method is known as trailing P. In this method, EPS for latest 4 quarters are added and then used as divisor to price of stock to calculate P. Trailing P is useful to calculate current market valuation of business if your investing method demands it. Next method of calculation is known as forward P. In this method, EPS for upcoming 4 quarters is calculated and then used as divisor to current price. Keep in mind, though forward P seems preferable, you should not forget the fact it is just an estimate. Majority of analysts you hear on TV when they tell you current PE of 12 is low, they actually mean they have calculated forward earnings of business in advance, and with respect to new earnings they got a forward PE lower than 12. Matter of fact is that you simply cannot take what an analyst is saying about P for its absolute face value. All valuations are relative in nature. You are supposed to know with respect to what P is low. A P of 10 can be low and it can also be high. It totally depends on with respect to what analyst is looking at P. So whenever someone tells you P is low, your question should be with respect to what and why. Because depending on your method of analysis and business in question, P can be low compared to historical average, P can be low compared to other businesses in industry, P can be low compared to business valuation, P can be low compared to broader market, P can be low compared to future earnings of business, P can be low compared to earning growth rate, P can be low compared to fast track growth of business, P can be low compared to growth prospect of business, P can be low with respect to business in question. Again, low PE doesn't always mean business is good to invest, nor high PE always means business is bad to invest. Businesses with high ROE usually have high PE. Their PE drops when their ROE drops. Expecting low PE in high ROE business is bad idea. Again, business with current track record of growth will always exhibit expanding PE. Failure in expansion of PE in such business is actually bad omen. Finally, in cyclical businesses, the arrival of new profitable market cycle is marked with high PE. Stocks usually bottom out with high PE and top out with low PE. My personal method of investing doesn't require use of PE or any other ratio. While investing, I totally depend on economic cycle of business, its balance sheet and income statement. With that said, the final conclusion is, with respect to method of analysis in question, PE might not be even an important valuation to look for. I hope that helps. Thanks for watching this video and have a nice day. First thing that you should know about ROE is that it is not just any basic ratio. It is measurement to understand performance of business. ROE tells us how efficient a business is in generating profit.